Good morning, everyone. It's already 11:15, so let's start today's webinar since we have a long list of things to update. Since Guangzi and Jeremy Tiong, who's covering China Aviation, Semcorp, as well as UOB, are currently away for results brief. So I'll start off with Raffles Met. Nonetheless, I'll leave the slides on for a few seconds for you guys to browse through. And of course, if you guys have any questions regarding the companies that I've just flashed through, please feel free to email to us at research@phillip.com.sg. So for Raffles Met, our titles for Raffles Met is a growth story with hurdles. So if you look at the overall results, the top line and the bottom line are not exciting. It grew by a low single-digit percentage on year-on-year basis. However, the key takeaways from the top line growth is that we see local patients continue to support the top line growth, although that we are seeing that lower foreign patient growth. So with this continual structural shift in lower foreign patient growth, we see a lower clinic contribution. So for this quarter, especially, this clinic revenue is mainly hit by a lower renewal in insurance policy by expats. So management shared that they continue to see that there's this retrenchment within, especially in the financial sector, which caused a lower renewal of insurance policy. Nevertheless, we still see a strong demand. This is supported by local patient growth. So local patient load continue to remain healthy in that sense. And as if you are following Raffles Med, you know that it's consistently or persistently being hit by their higher staff costs as they try to ramp up their expansion, especially for the Raffles Hospital extension, which is slated to open in December this year. So staff cost remains high at above 50% of their revenue, which they have in the previous years they have a benchmark against. But on a positive note, we are seeing that there's a turnaround in MCH where it has already broken even at EBITDA level. Shaw Centre as well. And Shaw Centre has actually started contributing to the operating profit line in the third quarter. And we shall see that both of these, the acquisition of MCH as well as the new Shaw Centre to boost operating profit in the next financial year. And as for their expansion plan, as mentioned just now, the Raffles Hospital extension, the two new China hospitals. These three projects are actually on tracks, and it should be opening in the end of 2017 this year for the extension, 2018 as well as 2019. So if you pass by the Bugis, you will be seeing that the building for the Raffles Hospital extension is already ready and up. They are currently doing some retrofitting in the interior, and they will be moving in the equipment soon. So they are going to start off with 60% of the floor area to their own usage for medical purpose, and the other 40% will be rented out for commercial purpose. So they're saying that they will be renting out to F&B, so there will be a food court there, and subsequently as demand increase, they will take back this floor area for their own usage and reduce the commercial area to 20%. And for the two China hospitals, management guided that there will be a startup losses to about 10 to 13% of their EBITDA in financial year 2019 and 20. So bear in mind that Raffles Med can actually generate 100 million EBITDA per annual. So a 10 to 13% of EBITDA, a 10 to 13% hit to EBITDA is still bearable. And we also earmark that 3 years for each of these China hospitals to break even. These two new China hospitals, we are positive on it, mainly because that it allows Raffles Med to tap into the growing healthcare industry in China, and also it provides a diversification to Raffles Med with a higher contribution for overseas operations, seeing that there's a structural slowdown in the Singapore healthcare. So with that, we actually upgraded our call from neutral to accumulate, and with a higher target price at $1.32. And with that, we would like to proceed, pass on the presentation to Te Hong, who will talk about Keppel-KBS US REIT.
Hi, good morning clients, Te Hong here. I will go on to talk about the upcoming IPO this Thursday, which is Keppel-KBS US REIT. So I'll give you a brief summary of the company snapshot first, and then we will go on to compare Keppel-KBS with the other locally listed REIT which holds office properties in US as well. So first up, Keppel-KBS post IPO market cap will be about US 550 million. This will be a tiny cousin of Manulife, which is about close to $1 billion US. For Keppel-KBS, what they hold primarily is office properties. They have 11 in total. Most of them are suburban, 70% suburban, and these will be across key growth markets in the US. For cornerstone investors, you can look at the table on the right. So mainly Effin Huang and some PB clients for Credit Suisse and DBS. For the REIT's exposure to clients' portfolio WALE is 3.7 years. This is quite in line with the average tenure for US office leases, which is average about 3 years. And for Keppel-KBS, I would say the tenant base is pretty diversified. You see that the top 10 tenants, they only occupy 23% of total rental income. And if you look at the top tenants, none of the top tenants, no one top tenant actually gives more than 3% of total rental income. So you have a good diversified mix there. As for tenant sector exposure, top exposure is for professional services, which include the likes of legal services, accountancy as well. And then next up you have finance and insurance service sector. That one occupies 29%. For debt post IPO, you're looking at average leverage of 36%, and 75% of their debt are hedged on fixed rate. For the investment merits according to management and according to the IPO prospectus, you see that firstly, they are diversified across a few key growth US cities. And these are cities which, if you look at the prospectus, you see that these are cities with, firstly, GDP growth above the US average, population growth above the US average as well. And apart from the potential acquisition growth, inorganic growth that is, management also highlighted the growth opportunities from organic means, such as you have built-in escalations. Most of the leases, 98% I would say, have built-in escalations of 2 to 3% per annum. And beside that, they also have the potential for growth in occupancies. Right now, the occupancy for the REIT is 90%. The REIT is targeting 92 to 95% by the next FY. And there is also a potential for positive rental reversion over the next few cycles. So all in all, I think one of the top things investors you guys may have in mind is that how would this compare to Manulife? We see that this is about close to half the size of Manulife, and for the price to NAV, you see that for Manulife, they're trading at a slightly higher premium to NAV, 1.08. Keppel-KBS will be 1.05. However, despite the premium price to NAV valuation, you see that the earnings for the Manulife's REIT actually still holds up better. It still offers a 7.1% yield compared to Keppel-KBS's 6.8. And on top of that, you also have it that Manulife REIT's gearing is lower. That gives them more firepower for acquisitions. You see that they have already effectively utilized this low gearing for an accretive acquisition a few months back. That was a CBD office tower in New Jersey. That cap rate 5.25 was good buffer over if you look at their average cost of debt of 2.6. And for both REITs, the properties are both on freehold tenures, and like I mentioned just now earlier on, occupancy for Keppel-KBS is 90%. For Manulife is 95.7. So on these fronts, and on the note that if you look at the investment merits for all this, like positive rental reversion opportunity, and if you look at the supply outlook for Manulife, they are not inferior to Keppel-KBS as well. So on these fronts, it would look as though Manulife REIT would have been a better, more compelling buy than Keppel-KBS instead. So with that, I'll pass on to Paul to talk about micromechanics.
Yeah, hi. Just an update on the micromechanics first quarter 2018 results. In terms of the key highlights, the positives for us was that revenue and earnings growth was double our expectations. Earnings grew around 50% plus, whereas we were expecting around 20 odd percent. Another key highlight was the development of their front end. This is a strategic part of their business. As you know, micromechanics is mainly on the back end semiconductor packaging, and they are making a long-term investment into front-end precision parts, we can see them making headway as revenue from the US division was up 50-odd%. In terms of the negatives, the one negative was that capex was to double from 5 million to 10 million. This is as a result of the utilization rate has increased to high 60s, and as a result, they need to expand capacity to cope with the current demand. In terms of the outlook, as we've highlighted in our report, this is the outlook for macro mechanics, at least in the near term, hinges a lot on the semiconductor sales cycle. So far, the uptrend remains strong, and do note that the semiconductor sales only started to grow in the double-digit terms only in late 2016. So as a result, we do expect another quarter of strong earnings coming up for micromechanics. And in the last two cycles, the year-on-year growth at least ran for 20 to 26 months, and the current cycle is about 30 months. So as a result, we maintain our buy and we raise our target price to 250, and we also raised our earnings by 18%. I will move on to our just an update on our Singapore strategy. This is essentially the key highlights from our November monthly, which will be released by tomorrow morning. Basically, the key macro themes that we see now right now is that there is no let up in the synchronized boom in global economies. In Asia, Asian exports are at 7-year highs in terms of growth rates. Our definition of Asian exports is mainly the electronic exports from Taiwan, Korea, and Singapore. In Europe, we do see the key IFO business sentiment index. These are at all-time highs since the early 90s. US is also picking up momentum. Retail sales growth is at 5-year highs. Consumer sentiment is at 17-year highs. And also the US wage growth, although marginally higher, but it's still at 8-year highs. For us, there is a secondary effect from all this, and we do see that we will be encroaching on the new era of rising interest rates. In the past decade, interest rates have plunged from 5 to as low as 1%. So we do see several pressure points on interest rates, albeit at a slower pace of acceleration. Some of the pressure points is firstly, of course, the global economy is humming. Secondly, at least for the current Fed, they are adamant, and they do still believe that inflation is around the corner. The third point is that ECB has gradually kind of starting to reverse their QE. And the fourth pressure point is that the US is taking a pro-cyclical tax cut stimulus. So basically, they are invigorating the economy at the point in time when the economy is really gaining a lot of momentum. And also, in terms of the past cycles, when you look at the past cycles, it takes 3 years typically for every Fed tightening cycle for a recession to start, and just for the recent Fed tightening only started at end 2015. In terms of our recommendation, not many changes. Our yield favorites are Asian Pay TV, CCT, and Asia Pacific REITs. Our property is CapitaLand Wheelock. Banyan Tree is still our long-term restructuring. We believe that this company will still capture a large pipeline of hotel management contracts from their two joint venture agreements, or the two new partners. Micromechanics and same thing. Our key sector pick is actually still remains banking. We think that as we head into 2018, you are getting almost a perfect scenario for the banks. Banks will be enjoying rising margins in view of the pickup in SIBOR. You will also see loans grow, supported by, as mentioned earlier, a strong global growth. At the same time, you have strong property sales. The third will be the wealth management, which is a new and extremely strong stream of income for the banks. And you also might have some special dividends if the capital ratios will be more relaxed, especially the CET ones. And finally, as you'll also get another kicker, will be lower credit costs as we head into 2018. That's it for me. We'll move on to Jeremy on his top, the Phillip 20 technical picks.
Good morning, guys. Jeremy speaking here. So for my part, I'll be just going through the monthly review for the Phillip 20 portfolio for the month of October. So for those that haven't been following this Phillip 20 portfolio, basically this is a portfolio that derives trading idea based on technical analysis, purely based on technical analysis. And within this portfolio, we actually filter down to a max of 20 stocks. So before going into the performance for October, I'd just like to take a look at the STI, the performance of October. So for October, STI gained 4.79%, totally wiping out the prior 2 months losses. And some price action to note from the weekly time frame, which is shown in the chart here over. Some point to highlight, for the past few reports, we have actually emphasized this 3189 support area quite a lot of times, and ultimately we're saying that if this particular line holds, this uptrend will stay intact, and on the flip side, if this particular 3189 fails to hold, the particular uptrend might actually reverse. So with benefit of hindsight, in the month of September and October, you can see this 3189 support area actually held up pretty nicely, and since then we have actually reversed off this particular line. Some notable price action within this 3189 support area was during this period over here, whereby we got this particular bullish break above this particular downtrend line, and ultimately the 3189 support area also coincided with the 20-week moving average, which then makes this support area even a stronger level. And hence you can see, since this particular bullish break, the STI continued with this particular uptrend kind of a trajectory, and ultimately with last week's close, the STI actually broke a new 52 weeks high. So last week actually closed above the 3356 July high, basically this high over here, the July high of 3356, and ultimately what it tells us is that the STI is still moving pretty nicely within this uptrend fashion, whereby it's making a series of higher highs and higher lows. So last week we actually broke a new high and ultimately confirmed the next higher high point is in the making. And what I mean by higher highs and higher lows, you can see since around March of 2016, the STI has been moving in this particular uptrend, and this being the first higher high in correspond to this particular point over here, as well as this being the higher low point in correspond to this low over here. It has been trending up within this higher high, higher low kind of a fashion, and ultimately with this particular bullish break above the 3356 July high, the STI is still moving and making new higher highs. So with this particular uptrend still pretty much intact and still going strong with strong momentum, the next level to watch out for in terms of resistance for the STI is this particular point over here, which is about the June 2013 high of about 3457 points, as well as the March 2015 high of around 3549 points. So for the STI, we believe that this bullish momentum should actually still continue to move higher to ultimately target the 2015 high of 3549 points. The only downside for this particular chart over here is probably this lower candle over here, which shows the RSI. So RSI measures momentum, and right now we are leaning towards the more towards the overbought side of things. Right now the RSI is around at 69, and hence the only downside is if STI continues to move higher from here on, and probably if it tests this 3549 area, we are expecting the RSI to easily reach a high of around 75 to 80, and then probably around that area some sort of a market correction might happen, and so just keep in mind that the RSI is actually nearing the overbought kind of condition right now. And just a little bit more on the Phillip 20 portfolio right now. So for the month of October, we actually had 3 new trades. So we entered into High P, OE, as well as Chasen. As you can see, these respective entry dates, respective entry price, as well as the stop losses. And for October, we actually also closed out High P at the same month. In the same month, I mean. So we entered in 3rd October and we exited on 17th October due to the bearish price action back then. And for High P, we actually netted about 17.73% and an average gain of around 0.89% for the portfolio. but high P since then has been moving higher. Bullish momentum still seems strong. So we'll continue to monitor high P moving forward to actually continue to position for the dip to get back into the uptrend for high P. And here's just the performance on the Phillip 20 portfolio since inception. So for the Phillip 20 portfolio, we actually started the portfolio in May, and we monitored the monthly performance as well as the total return performance in the following slide. So you can see over here the monthly performance. The blue bar actually shows the Phillip 20 portfolio return, and the orange bar shows the STI performance. For the first 3 months, May, June, and July, we underperformed the STI to a certain degree. But ultimately, we catched up in the most recent 3 months in August, September, and October. So for the month of October, we actually yielded 4.9% for the month of October in comparison to 4.8% for the STI. And in terms of the total return-wise, since May, inception date, right now, as of last month, 31st October, the Phillip 20 portfolio total return stands at 8.3%. As opposed to the STI of 6.3%. And same thing over here, which is similar to the monthly performance. We lagged the STI for the first 3 months, May, June, July, and ultimately caught up to the performance of the STI and the bullish momentum in August, September, and October. And hence, this is the watch list that we are currently monitoring. Right now, the Phillip 20 portfolio has 19 stocks, and we say that the cap for the portfolio is 20 stocks. So right now, we still have one more slot within the portfolio to fill. So here are the watch list that we are monitoring to actually add in new stocks, new trading ideas into the portfolio. And basically, if you were to pull out the charts for all these stocks over here, basically they are uptrending, bullish momentum kind of stocks. And what we want to catch over here is the dips to reposition back into the uptrend. And last but not least, here's the current portfolio, the open trades within our Phillip 20 portfolio. Respective entry price, date, stop loss, as well as last price. And take profit wise, it's not included in this table, but whenever we think it's a good time to take profit, we will all be reflected in the daily technical pulse report. But for a brief guide on where to take profit, we actually included some guide as well as the figures to take profit in the individual technical pulse reports. And hence, with that, we've come to the end of today's webinar. So if there is any question, we'll pause right now for Q&A. Thank you.
Hi guys, I see a question for Keppel-KBS REIT. The offer price is US 88 cents.
Hi, this is Jeremy speaking. There's a question asking, will we revise the stop loss for UMS higher since the price has moved up a little bit? We tend not to move the stop loss too much, and we usually keep it to the same level as our initial report. However, in terms of stop loss wise, we will only sort of give some sort of an update whenever we see notable price action on a day-to-day basis. So for example, if we see some sort of a market correction in anticipation that's coming, then probably we'll close out some strong bullish running kind of counter. So for UMS wise, yeah, we won't be revising the stop loss anywhere until probably we see some sort of a bearish price action that we deem is threatening.
Hi, there's a question on Raffles Medical regarding the hospital extension. So, what's estimation of growth? Um, we actually okay, the Raffles Hospital intends to start off the operations by adding about 50 to 100 operational beds into the extension by end of this year, and within 1 year's time range as well. So if they start off with 50 beds, that's actually about 25% of additional capacity to its hospital services already. So with that 25% additional capacity, we actually factored in about 10% growth to its hospital revenue. So that's actually bring us to our target price of $1.32.
Hi guys, question on Keppel-KBS again. Question is the starting gearing ratio of 36%. Yes, I think it does seem like at that kind of level, any acquisition after IPO, it could involve either a placement or a rights issue. And we did mention the advantage that Manulife has over Keppel-KBS in this aspect as well, in that they do have a lower gearing ratio as of now, and that gives them a higher firepower for potential acquisitions. And note that the Keppel-KBS, they do not have the ROFO to the properties under KBS currently.
Hi, there's a question asking where can I find the list of the updates on the Phillip 20 portfolio. So basically all our reports can be found on stocksbnb.com. So if you haven't visited this website before, I urge you guys to come to this website. So here is where our reports can be found, including our fundamental reports as well as our technical pulse report, as well as our previous webinar, all on this landing page. But mainly for technical pulse wise, at the top panel over here, just click onto the technical pulse, and all the previous trade recommendations are listed here. So just probably click onto it and you will see the details and the rationale behind why we gave this particular call, with entry price, stop loss, take profit, some support and resistance level, as well as the narrative over here. And yeah, that's all for this website. So do take some time to explore this website, with a lot of information on this website. Okay, since there are no more questions, we'll end today's webinar here. Thank you very much for your attendance. We hope to see you guys again next week. Thank you.